Our last speaker for this session is Karol Palutwit. I hope I pronounced your surname correct, and will present his paper on excess reserves and monetary policy tightening. Karol is a senior research economist and deputy head of financial market research section at the Directorate of Markets at Deutsche Bundesbank. His research focuses on the empirical analysis of financial intermediates. Karol, the floor is yours. Thanks.
Thanks a lot for the introduction, and thanks a lot for the opportunity to present this work here at this conference. So the title of our paper is Excess Reserves and Monetary Policy Tightening, and this is joint work with Daniel Fricke, who has just discussed the paper by Raimund and Stefan Gretmeier. We are all from Deutsche Bundesbank, and the usual disclaimer applies. So let me first of all motivate our research question by showing you two stylized facts on this graph. So the first stylized fact is the evolution of the green line, which shows the evolution of central bank reserves. So these are the reserves that banks hold with the national central banks, and this is an asset side of the bank. And you see that these reserves in the euro system have grown tremendously over the recent years, which is because of the various quantitative easing measures that we have introduced in the eurozone. So at the end of 22, the absolute level of reserves was above 4 trillion of euros, and this accounts to approximately 12% of the total balance sheet of the banking sector. And to put this into perspective, in 2008, this figure was at about 0.75% of the total balance sheet of the banks. Yeah. So we see a huge increase in absolute and in relative terms. And the second stylized fact is this red line, which shows the evolution of the deposit facility rate. So this is the rate that banks obtain when they deposit those excess reserves with the National Central Bank. And this rate turned negative in 2014, meaning that banks actually had to pay this interest to their national central banks when they deposited those reserves with them. And then in July 22, this rate was arisen. So we started to fight inflation, and therefore we increased interest rates, which means that banks are now earning risk-free interest income on those reserves. And this has created a very unprecedented situation. So on the one hand, we want to fight inflation. We actually want banks to slow down their credit supply to meet this end. And at the same time, there are kind of interest income generated, which might actually create incentives for some banks that have a lot of reserves to not slow down credit as strongly. So the governor of the Banque de France has described the situation as follows. So let me read out this quote to you. The return of policy rates to positive territory would this time provide a sizable risk-free income to the banking system and a similar loss for the euro system. The effect on bank net interest income, nevertheless, if opposite in sign to the one under negative rates, could also distort the transmission of monetary policy. So what we look at and analyze in this paper is whether the transmission via bank lending is different in the cross-section, so for reserve-rich banks, when reserves are well remunerated. So let me briefly describe the theory and the main mechanism that we have in mind. So according to the bank balance sheet channel, when the policy rate is increased, then the market value of assets on the balance sheet of banks is decreased, and this weighs on their net worth and potentially leads to a reduction of credit supply. Now, in the recent rate hiking cycle, with those large levels of reserves, when policy rates are increased, this, of course, also leads to a decline in the market value of non-reserve assets, but at the same time, there is interest income generated for banks holding a lot of reserves, which might affect their net worth positively and potentially lead to a slower decline of credit supply. And this is actually a key finding of our paper, that reserve-rich banks' credit supply is less sensitive to the recent monetary policy tightening. So before I jump into our empirical model and specification, let me first of all highlight the very special feature of central bank reserves. So they are the most risk-free and liquid asset available. In a de facto floor system, as we have it in the Eurozone, they become a store of value, and they can only be held by banks, not by other agents. And broadly, the central bank sets the aggregate level of reserves, and bank can then only redistribute. And most importantly, reserves are really an abundant supply. So I've said this already, we have more than 4 trillion euros of reserves. And if you compare this to a very, like the most comparable asset, which would be short-term euro area government bonds, they, like the total amount outstanding stands at 0.7 trillion. So it's less, and those government bonds can also be held by other institutions, not only by banks. Okay, so yeah, related literature are very important. Let me skip that due to time constraints and directly talk about the data that we use. So we use then a credit data set, which is a harmonized credit register, which includes for the entire Euro system, and it includes loan level data for all Euro area banks to non-financial corporations whenever the loan amount exceeds the threshold of 25,000 euros. So it's a very rich data set. And we match that with bank balance sheets and the bank interest rate statistics to obtain asset and liability items and deposit interest rates. We further match that with bank financial reports data to obtain profit and loss accounts. And we also look at daily stock prices, which we obtain from Refinitiv Icon. Our sample period runs from January 22 until February 23. So we stop before the financial market stress induced by Silicon Valley Bank. We work with a sample of 483 banks, which account for 71% of total assets. We have more than 3 million firms in our sample and approximately 500,000 firms with multiple bank relationships, which will be important for the identification. So we have over 43 million bank firm level observations in our data. Okay, so let me walk you through our main empirical specification. So this is actually a plain vanilla credit supply regression where we regress credit from a bank to a firm in a month T. And we are mostly interested in this coefficient estimate beta of the interaction term between this variable RR, which is the average pre-period reserve ratio of banks, interacted with this DFR variable, which takes the value of 1 after the interest rate hike, so after July 2022. And in the setup, we control for time-varying bank characteristics. We also control for firm times time fixed effects to control for demand from the firms. And we also control for bank times firm fixed effects. We also include bank times firm fixed effects to control for any non-exogenous matching between a bank and a firm and a bank. And as I said, we are interested in this coefficient estimate of the interaction term, which is beta, which gives us the difference in credit supply after the ECB's monetary policy tightening when increasing the reserve ratio by 1 standard deviation from the mean. And our main hypothesis, as I said, is that beta is positive, so meaning that reserve-rich banks' credit supply is less sensitive to the monetary policy tightening. So before I go through our main regression results regarding credit supply, let me first of all show you the results on net worth. So I said on the theory slide that the effect works through net worth. So let's have a look at that first to set the stage for the credit supply regressions. And what we've depicted here is are the stock returns of banks with a high and banks with a low reserve ratio. And you see that after the interest rate started to raise in July 22, the stock returns of high reserve banks are significantly larger than those of low reserve banks. So this is the first proxy for an effect on net worth. And we look at that even more directly by looking at the profit and loss account data. And what I show you here in this table is actually the effect for various profit and loss account variables. In column 1, we detect a positive effect on the interest income of banks. We do not detect any significant effect on the interest expenses, which then results in a positive and significant effect on the net interest ratio. This also translates into profitability measures, so a positive effect on return on assets and also on book equity. So we've established the result that banks with large reserve ratios due to the remuneration of reserves actually have an effect on net worth. And let me now go to our credit supply regressions. And here in this table, I want to draw your attention to column 4 because it's the most strict identified result that we have. And here we find a positive coefficient on our interaction term, and it's also economically meaningful. So increasing the reserve ratio by 1 standard deviation leads to an increase in credit supply by 0.84%. And in economic terms, this corresponds to an increase of 0.25% of 2022 euro area GDP. So it is also sizable and economically meaningful. We run different robustness checks. So due to time constraints, let me maybe just draw your attention to column 1. So one concern with our identification might be that the reserve ratio is not exogenously determined, and that there might be some other time-varying factors that are correlated to the reserve ratio and that also affect credit supply decisions of banks. And what we do in column 1 is we exclude all time-varying bank level control variables from our setup, and we find that the coefficient is actually halved, which is evidence that the correlation between the unobserved factor and our coefficient estimate is negative, meaning that what we actually obtain as coefficient estimates is the lower bound. So it's conservative estimate, and it makes us confident about our results. So the last result that I want to highlight before I conclude is looking whether the result is binding at the firm level. So it might be the case that firms that are obtaining more credit from a bank with large reserves are simultaneously decreasing their credit from banks with a low reserve ratio, which would result in a zero-sum outcome at the firm level. And we collapse our data at the firm level, and in column 2 you see that the result survives, meaning that our results are binding at the firm level, and it might also suggest the presence of real effects at the firm level. So let me conclude. The main finding of our paper is that reserve-rich banks' credit supply is less sensitive to monetary policy tightening. We find a positive effect on net worth. We have many more additional results that I did not have the time to walk you through, but let me just read them out to you. So the credit supply effect is stronger for smaller and worse capitalized banks, so those banks that face more financial frictions, and it is directed towards smaller firms with higher credit quality. And the results, as I've said, are binding at the firm level, which indicates the potential presence of real effects. So let me conclude with the second bullet point. So there's a huge ongoing policy discussion on the remuneration of reserves at the moment. And the ECB has actually adjusted the remuneration of the minimum reserves. So this has been set to 0%. And we are looking forward to how this discussion is evolving, and we hope that with our paper we can also contribute to this policy discussions. Thanks a lot, and I'm happy, looking forward to your discussion and any comments and questions.
Thank you. Now let me invite back Raymond for the discussion. Thanks, Raymond.
When I first got this paper and I opened up my email, I thought I got like a perfect match. I guess maybe like on a dating app, you get like the perfect person or something like that. I was really happy about getting this paper. So, it's a fascinating paper. Very, very much enjoyed reading it. And I believe the results. Highly recommended for everyone to read. So just a quick summary of the paper. Given a bank's reserve ratio before rates rise, their average reserve ratio, how does this loan amount change when interest rate rise? And the authors find that banks with higher reserve ratios lend more to their clients after rates rise compared to banks with lower reserve ratios. And the bank firm fixed effects means they compare loan amounts within the same bank firm pair over time. So you imagine if a BNP Paribas lends to Total $1 billion a year, that $1 billion is fixed in that relationship over time. So what's the variation from that? Okay, so let's say firms borrow from two banks. A bank with high reserve ratio lends more reliably after rates rise. Credit tightens than banks with low reserves. So you imagine if you're a company with two different banks, this bank with higher reserve ratios is kind of more reliably lending after rates rise, and they're worrying about tightening credit standards. Monetary policy might be less effective on these banks with, possibly more the most QE. Bank level reserve variation may be tied to the QE expansion. Okay, so this is a very unique contribution to the literature. This data set just seems like a really, really great data set. And a lot of the loan level data. And when you look at it looks at the relationship between reserves and lending during a period of ample reserves and rising rates. So during the second half of 2022, reserves are 4.6 trillion euros, and the deposit rate goes from minus 0.5% to 3%. So Europe has had negative deposit rates with a longer history of interest on reserves than the U.S. Could you click the thing that says deposit rates? Yeah. Oh.
Maybe you can continue.
Yeah.
In the interest of time until.
Okay. Yeah, I guess. Okay, I'll just not do it. It's okay. It's okay. No problem.
Just in
Okay.
the interest of time.
Yeah, and so Europe has a much longer history of interest on reserves than the U.S. And U.S. banks have these overnight reverse repos to soak up liquidity. That's also something that was different. Europe has TLTRO, which is pretty fascinating to look more into this. And this suggests reserve deposit rates play a greater role in bank valuations, especially in Europe, because there's such a long history of deposits on reserves. Okay, so there's a couple papers that shows during QE the relationship is positive between reserves and lending. Here they see that the treatment of being in the top quartile of MBS holdings is positive on QE and lending. Here, I don't know, this paper is missing from the literature review of the paper, but they use a IV to show more reserves meant more lending. I also have a paper that shows after controlling for QE, the interest on reserves minus 3 months treasury, that actually increases reserves and reduces lending. But as so that's a paper that I have as well. So the major questions I have about this paper is, so what's the baseline relationship between reserve ratios and lending? So during QE, it's positive. The literature seems to say it's positive. After controlling for QE, my paper shows that after controlling for that is negative. So if high reserve ratio banks initially lend a small amount, if that relationship, so then it's reliable lending. Maybe there's a different interpretation to it than if a higher reserve ratio was, lending at not that much of an amount before rates are rising. So I just kind of wanted to understand that a little bit. And what if low reserve rate? What if these low reserve ratio banks are reducing lending due to paying back the TLTRO? So the bank firm fixed effect, it doesn't address time varying omitted variables that influence both reserve ratio and loans, like the TLTRO. So if the TLTRO allowed banks to borrow at negative rates, under condition they pass on the savings to borrowers, which is amazing to read about these details. Nothing like that in the U.S. Smaller banks are more desperate for alternative financing because they can't access the covered bond markets. So in that sense, kind of wondering what role that played. So the baseline relationship maybe can be maybe just to supplement the regressions. Maybe if there's just to see what the baseline effect is. So what's the average effect of reserve ratio on loans before the rate rise? So that might inform what happens after. So just to kind of see what that is. And I think I already spoke to or emailed Carol about this, but yeah. So and then we can see what do banks with different reserve ratios respond differently to rising rates given what they did before. So just kind of wondering what they did before. So this time varying omitted variable possible. Banks have 20% securities in U.S. and EU. This is from the Palutkiewicz paper, your paper in 2021, also about 18%. But yeah, I think in the paper there was 8%. So I'm just kind of wondering what happened, or is it a different category? Also banks with higher reserve ratios, did they sell securities to the ECB through the asset purchase program? Is that why they have higher ratios? Or did they borrow more from the TLTRO and hold reserves? So we could see here that as soon as you can see excess liquidity in the euro banking system going down as soon as the TLTRO payback was happening. So that's something to just wondering what that could be. So the effective credit supply in the paper says is stronger for smaller banks. Does it have to do with smaller banks not accessing covered bond markets? Also, so they may have to draw down on the reserve ratios and loan simultaneously to pay back these TLTRO. So maybe that positive relationship is driving the differential. Importance of smaller banks might be overlooked in some regions. I know, Germany, Austria, and Italy, they have more small banks than other regions. During Dodd-Frank, a lot of smaller banks were overlooked until there was a conference started at the St. Louis Fed, where it was really successful. So a lot of the Federal Reserve found out a lot more about specific smaller bank issues that were because most of Dodd-Frank was so geared towards big banks. So you do see reserve ratios falling after rates. So is the prior higher rates, is it due to 90 billion in ECB net purchases during April to June 2022? So maybe these larger trading banks selling securities, they have higher reserve ratios. Is there a predisposition to replace reserve ratios with loans like Carol's paper 2021. So if these smaller undercapitalized banks, if they have a larger share of TLTRO, so that unwinding may have a stronger binding effect on reserves and lending. You can see also the drop in liquidity in the Euro banking system. There's a sharp fall here. There's a sharp fall here. That's in line with the TLTRO payback. Whereas if this was associated with the asset purchase program, that was kind of like a slower, more gradual reinvestment. So you wouldn't see this big drop in liquidity in the Euro banking system. So it seems to suggest it was the TLTRO that's responsible for that. And then so just small suggestions here. I'll just kind of skip over them. Yeah, so other ideas, maybe trading banks with high reserve ratios, maybe they act differently during tightening if their high reserve was from the asset purchase program because of these different relationships between, predisposition to replace securities with lending. So maybe that has, something to do with it as well. Is also if the TLTRO winding down links reserves and lending, maybe that has some different implications as well. So maybe do longer banking relationships, do they remain sticky? When the TLTRO is winding down, something thinking about what's the transformation of loan maturity, credit risk, industry composition from higher risk to lower risk that you see in the paper. So, maybe that's another area to look at, and lower risk loans, maybe they're transitioning into lower risk loans because the replacement of the very low risk TLTRO money. So there may be some just low risk bucket that they're trying to replace with that as well. So in conclusion, the results are intriguing. Excess reserves, could make the monetary transmission of monetary policy more difficult. Additional specification, just suggesting maybe to show the baseline effect between reserve ratios and lending, just to have a better interpretation of what's happening after higher rates. And is it asset purchase program or TLTRO program that's responsible for these higher reserve ratios? Because that tightening impact might have a different implication. There's different heterogeneity from exposure to APP and the TLTRO. TLTRO channel, it can bind reserves and loans more closely, whereas that seems to be because the liquidity, there's a huge drop off in the Euro banking system that seems to be more aligned with TLTRO than gradual reinvestment of the APP or reversing of that. So this relationship driven possibly by TLTRO, that also introduces a cross-currency and monetary policy that, it could be something that could help with the interpretations in the paper as well. Okay.
Thank you, Raymond. Maybe in the interest of time, we take 1-2 questions. Yeah.
Yeah, very interesting paper. So I maybe two questions. One question.
Maybe can you wait for the microphone? Thanks.
Yeah, thank you. Very interesting paper and great presentation. So Alessandro Scopiliti from CAU11. So two questions. One question is about, let's say, the development that you have in the reserves. I mean, of course, when you consider reserves which are not minimum reserves, there is not, let's say, a strict relationship between the amount of reserves and the amount of deposit. But to some extent, if you have banks which have a large amount of, let's say, excess reserves, you can imagine that they have, let's say, also accumulated quite some amount of deposits, possibly because of QE purchases. So my question is, for these banks, it is also possible that the share of liabilities which is composed by deposits is relatively larger than for other banks. But if this is so, then the interest rates that they would apply on deposits are, at least if we look at the deposit on the current accounts, are still relatively low. So this means that banks would be able to take an intermediation margin between the loan interest rate and the deposit rates, which is pretty large. So thinking about your results, do you think that potentially when you look at those results, this could be driven more by factors related to the large intermediation margin for banks which have a relatively larger deposit base compared to banks which have a lower deposit base with respect to their liabilities? And maybe a last point, and I'll be short on that. Have you thought also a bit, I guess, of course you have already, thought about the policy implication in terms of the interest rate corridor?
in the sense that at the moment, interest rate corridor is indeed asymmetric. Let's say it's 50 basis points between the DFR and the MRO, and 25 basis points. But in the past, there has been even larger asymmetry. So have you considered that, and what could be the implication in that sense? Thanks.
And Jakob has another question.
So a bit in a slightly less sophisticated way of expressing what you just did, right? I think that the fact is that for the banks, there's been a carry trade for a while, right? Where you could actually borrow money from the ECB and put it back into the ECB and make a positive return, right? That carry trade that was killed a little bit before. I mean, maybe we have some experts on the timing, but it was stopped before, and that's your asymmetry point, right? That gave room for that carry, basically. That was stopped before the TLTRO repayments had to happen, right? Now, so that's one observation. I think you need to somehow get the timing right, because that's probably part of what you see. The other aspect is that we know, I think that's now public, right, that a lot of banks simply took their reserves at the ECB and they paid back the loan, right? So they just took reserves and they paid back the TLTRO. So a bit to your point about who has deposits and who's actually in need of anything, my sense is that if you go now and look at the numbers, a lot of the larger banks, which were big takers, right, basically just put back the money. They took money out of one account at the ECB and paid it back somewhere else. And that was it, because the carry trade ended, and that was sort of the end of the story, right? And they weren't really in need of it that much. Whereas some banks definitely had a bit more of an issue, right? Yeah. So I think there's a bit of a heterogeneity where the bigger banks were probably less affected, and some of the other banks were more affected. But again, that deposit surplus versus what you're actually doing at the ECB is probably more, you need to have a look at that, because that's probably quite important to understand the impact, and hence at the end of the day, the policy transmission effect, right? Yeah?
Yeah.
Yep.
Thanks a lot for the very nice suggestions by you, Raymond, and by the... Oh, it is on?
Yeah.
Off and on. Off and on.
Oh, okay. Now you hear me? Yeah, perfect. Thanks. So thanks a lot for the excellent comments, Raymond, and also to the audience. Yeah, let me address some of them. So regarding the TLTRO, this was raised a couple of times. What we actually look at, and Raymond showed that in his discussion slides, is the stability of the reserve ratio over time. So we plot the pre-period reserve ratio against the post-period reserve ratio, and we see that it ended up on this vertical line. So it is pretty stable over time. Another point regarding TLTROs that I want to make is that there were some voluntary repayments, right? So that what you saw at the end were this voluntary repayments, so no mandatory repayments. But still, I mean, this stability of the reserve ratio makes us confident that that this is not driving the results. But however, we will look into that even more after this was raised a couple of times. So we have the TLTRO data, so we can do that. And actually, this TLTRO data also helps us to address the second comment that you made, Raymond, regarding borrowed and non-borrowed reserves. So looking at the APP, what fraction of reserves is coming from the asset purchases and what is coming from the TLTRO. So borrowed, non-borrowed, which is something that is discussed heavily at the moment. So we will definitely go into that. So thanks for raising these points. Yes, regarding deposits. So we do a little bit regarding that because we have like the deposit ratio as a control variable. We actually, I didn't have the time to show it here, but we dedicate a whole chapter in our paper looking at deposit pass-through. So, of course, the pass-through in reserves is 100%, right? Because the deposit facility rate is the interest on reserves. And regarding deposit rates, banks sluggishly adjust that, right? But we have a whole chapter showing that there's no differential deposit beta for banks with a high reserve ratio and low reserve ratio. So we are confident that...
Which is striking, right?
Yeah, that's true. Yes, and regarding the effect on loan rates, the differential effect of loan rates and deposit rates, maybe what is also interesting, what we look at in our paper is the fraction of loans that have a variable interest rate as opposed to those that have a fixed interest rate. And we find that the effect is even stronger for those with a variable interest rate, which makes sense, right? Because they increase the interest rate directly on those loans. So it gives us credibility that our results are meaningful. But yeah, thanks for raising that. So we can think more about deposits. Actually, what we also do is we check whether there's a differential change in deposits among those banks with a large reserve ratio and with a low, and we don't detect any differential outflow of deposits for those two groups. Yes, so yeah, thanks a lot for the comments and for this wonderful conference.
Do you want?
Okay.
Yeah, we can take another.
Yeah, thanks for allowing the question. So yeah, I mean, actually, it's quite a simple question. I wondered whether you can also come up with aggregate implications of that, because when I from the perspective of a monetary policymaker, this heterogeneity is very interesting, but the ultimate question is, what does it mean in the aggregate? How does it impact the transmission mechanism? And I mean, the best outcome, in a sense, from this point of view, would probably be to also, expand that relative to previous hiking cycles, and then the difference to the current one and how much this actually has affected the monetary policy distribution. So that would be quite interesting.
Yeah, thanks a lot for this question. So we're actually working on the aggregate effect. So you're right. So what we are doing here is looking at the effects in a cross section. So we cannot kind of extrapolate to aggregate effects based on our findings. And yeah.
Because we're running a bit out of running over time, maybe you can be brief and you can discuss over the coffee break. Sorry.
Okay, I'll be very brief. So it's very important to control for demand effects here, because interest rates were rising and firms, in expectation of the rising interest rate, wanted to make sure that they get credit with the lower rates, right? So this demand controls are very crucial in our setup. And this gives us a hard time when, leaving them out and looking at the aggregate effects. So we are still working on that to find some methodology. So if you have any suggestions, please email me. And okay, so thanks.
Thank you all. So we're now having a coffee break and we'll be back in 10 minutes at 12:10. Thank you all for your presentations and comments.